Today, the DFA Daily to the 17th of June 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today we look at the latest information from the ABS relating to unemployment and migration, and also look at Philip Lowe's recent comments about the risks around too much debt. The seasonally adjusted unemployment rate fell to 5.1% in May 2021, with employment increasing by 115,000 people from April to May, according to the Australian Bureau of Statistics. So the jobless rate is now back to where it was in February 2020 and is just 0.1 percentage points off the federal budget's forecast for a year from now in June 2022, according to the ABS. And they said that May was the 7th consecutive monthly fall in the unemployment rate. The underutilisation rate, which combines unemployment and underemployment, decreased by 0.7 percentage points to 12.5%, and that's the 8th consecutive fall and the lowest level since February 2013. These are very strong numbers, and as you might expect, the market liked them and moved higher. The unemployment rate fell to 5.1%, which was below the March 2020, which was 5.3%, and back to the level in February 2020 at 5.1%. And the declining unemployment rate continues to align with the strong increases in job vacancies, they said. The number of unemployed people fell by 53,000 people in May, down to 701,000. And the number of unemployed people has fallen by around 303,000 since the peak of 1 million unemployed people in July 2020. The youth unemployment rate increased by 0.1 percentage points, but remains low at 10.7%. The last time we saw a youth unemployment rate as low as it is in April and May was in January 2009. The latest fall in the unemployment rate coincides with a strong increase in employment between April and May. Employment increased by 115,000 people in May, following the 31,000 fall in April, which was around the Easter holiday period. Over the past 2 months, employment increased by around 84,000 people and was 1% higher in May 2021 than at the start of the pandemic, the ABS said. The number of employed women increased by 69,000 in May, and the number of men by 46,000. Female employment was 1.6% above the start of the pandemic, compared with 0.5% for men. The increase in female employment in May means that a higher percentage of women are in paid work than ever before, at 58.8%. That's 0.7 percentage points higher than the start of the pandemic. The difference was even greater for women aged 15 to 64, whose employment to population ratio in May was 1.5 percentage points above March 2020. The hours worked increased by 1.4% between April and May and 0.7% over the past 2 months, and hours worked were 2.9% higher than at the start of the pandemic, 4.1% higher for women and 2.1% higher for men. The participation rate increased 0.3 percentage points to 66.2%, following the 0.3 percentage point fall in April, and was close to historical highs of March 2021 at 66.3%. The female participation rate increased 0.4 percentage points to 61.7%, also close to its March historical high, and the male participant rate increased 0.1 percentage points to 70.9%. Underemployment decreased by 0.3 percentage points to 7.4% in May. That's the lowest level since January 2014, and that was 1.4 percentage points below the start of the pandemic, 1.9 percentage points below for women, and 0.8 percentage points for men. The underutilisation rate, which combines unemployment and underemployment, decreased by 0.7 percentage points to 12.5%, and that was the 8th consecutive fall in the underutilisation rate since October 2020 and the lowest level it has been since February 2013. So even allowing for sampling changes, which come in and out during the year, and other factors, these are strong results. And of course, it does underscore the fact that people are working. The question is the quality of the jobs they have and the income that's being generated. Just working an hour or two a week classes you as employed. And we know that there are a number of people with multiple part-time jobs in these numbers. So it doesn't tell you the full story by any means. Now let's look at Australia's population, which grew by 0.5% during the year ended the 31st of December, according to the latest figures from the ABS. They said that 2020 was a year of unusually low population growth in Australia due to the effects of COVID-19 on overseas migration. During 2020, Australia's population grew by 0.5%, 136,300 people, to 25.7 million, compared with a growth of 1.5% in 2019. Natural increase accounted for 97.6% of annual population growth, while net overseas migration accounted for the remaining 2.4%. This is a shift from the long-run trend of net overseas migration driving the majority of Australia's population growth. With COVID-19 international travel restrictions still in place, net overseas migration was down 98.7% compared with the previous year, driven by a decrease in overseas migration arrivals at 59.9%. There were 243,500 overseas migration arrivals and 240,200 departures during the year ended the 31st of December 2020, resulting in net overseas migrations of 3,300 people. Just over half of these movements were in the first 3 months to March 2020, prior to the closure of Australia's international borders. In 2020, there were 294,400 births and 161,400 deaths in Australia. A natural increase during this period, therefore, was 133,000, a decrease of 4.5% from the previous year. Now that, of course, should put lower pressure on home prices ahead, and we already know that there is more supply of property than demand for property. But I also expect the bank and the government to look to try and increase migration, because frankly that's the only growth lever they really have. Think about the consequences, of course, with yet more people coming back in once the borders are open, which won't happen probably until next year. Now, the RBA Governor, Philip Lowe, said that future potential macro-potential policy options that APRA was exploring included restrictions on debt-to-income ratios and loan-to-value ratios, and tougher rules for interest-only and investor lending, like between 2014 and 2018. We're not at the point where we're actively considering implementing any initiatives in this area, but we're doing the preparation for what might happen, what we might do if credit growth was accelerating, Dr. Lowe said, following a speech in Toowoomba. I don't think it's in the country's interests to have an extended period where credit growth is running way ahead of growth in our incomes, particularly given the high levels of debt. So they're looking at the housing market and definitely paying close attention to the increase in household borrowing. The RBA does not and should not target house prices, he said. We do, though, have a strong interest in trends in household borrowing, especially given the already high level of household debt in Australia. It is important that lending standards remain sound in an environment of low interest rates and rising housing prices. At its meeting last week, the Council of Financial Regulators also discussed the risks that could arise if growth in household borrowing substantially outpaced growth in household income. This is not the case at the moment, but the Council did discuss possible policy responses to a scenario in which rapid growth in household debt posed highlighted risks to the future stability of the economy. Which does take us direct to the Council of Financial Regulators, or Philip Lowe's other brain, as I sometimes call it. The Council of Financial Regulators, let's call it the Council from now on, is the coordinating body for Australia's main financial regulatory agencies. There are 4 members: the Australian Prudential Regulatory Authority, APRA, the Australian Securities and Investments Commission, ASIC, and the Australian Treasury, and of course the Old Reserve Bank, who chairs the meeting. The RBA also provides secretariat support. It's a non-statutory body without regulatory or policy decision-making powers. Those powers reside in its members, and the Council's objectives are to promote stability of the Australian financial system and to support effective and efficient regulation by Australia's financial regulatory agencies. In doing so, the Council recognises the benefits of a competitive, efficient and fair financial system, and the Council operates as a forum for cooperation and coordination among member agencies. It meets each quarter, or more often if required. So much for the independence of the Reserve Bank, because of course the Treasurer is at the table there. Topics covered include housing market risks, financial risks from climate change, financial market infrastructure developments, cyber risks, and the regulatory arrangements for e-conveyancing. The Australian Competition and Consumer Commission also attended for selected agenda items. Members discussed developments in household borrowing and the housing market. Housing credit has picked up and a further increase is expected over the months ahead. Over the past few years, owner-occupiers have accounted for most of the increase in household borrowing. The demand for credit by investors has been subdued but is now increasing. Housing markets are strong across Australia, and Council members reiterated the need for lending standards to remain sound in an environment of low interest rates and rising housing prices. There have been signs of some increased risk-taking recently, but overall lending standards in Australia remain sound, they said. APRA has written to the largest authorised deposit-taking institutions, banks, to seek assurances that they are proactively managing risks within their housing loan portfolios and will maintain a strong focus on lending standards and lenders' risk appetites. And Council members are also paying close attention to the implications of trends in household debt. They discussed the risks that could build if growth in household borrowing substantially outpaced that in income, as well as potential policy options to address those risks. And also the Council discussed financial risks arising from climate change. 2 current initiatives will help to increase the preparedness of Australian financial institutions to manage those risks. First, APRA has released a draft prudential practice guide on climate change financial risks, which will apply to ADIs, insurers and superannuation funds. The guide sets out high-level principles for how APRA expects institutions to evaluate and mitigate financial risks relating to climate change. And second, Council agencies are collaborating on APRA's climate change financial risk vulnerability assessment of the 5 largest Australian ADIs. This will model institutions' exposure to physical and transition climate change risks. APRA intends to publish aggregate findings by around the end of the year. And Council members also discussed how the attitudes of investors to climate change risks were changing and the importance of appropriate disclosures. And finally, it's been reported that Liberal MPs are demanding the federal government consider radical plans to bring the runaway housing market under control after new figures show the value of the nation's homes soared by a record $450 billion in 3 months. Sydney MP John Alexander said some of his own government's policies were feeding into dysfunctional property markets, while Melbourne MP Tim Wilson said the tax system has to be overhauled to bring some balance back to house prices. Data from the Australian Bureau of Statistics released on Tuesday showed that dwelling prices jumped by 5.4% through the March quarter. That's the largest quarterly lift since the end of 2009. All cities reported an increase, led by Sydney up 6.1%, Canberra by 5.6%, Perth, they were up 5.2%, while in Melbourne they increased by 5.1%. The total value of the nation's 10.6 million residential dwellings increased by $450 billion to $8.3 trillion, the single largest quarterly rise on record. The average price for a dwelling in New South Wales is just over $1 million now, an increase of $115,000 over the past 12 months. Victoria's average price is now $834,600, a $73,000 lift since the March quarter, and the ACT not far behind at $810,000. But at the same time, special research led by UNSW found that the national economy was less stable and suffering from a drop in productivity due to runaway house prices. It found the lift in prices was diverting money away from more productive pursuits and affecting the lending policies of the nation's major banks. Mr. Alexander said all governments had to work together to put in place policies that would gradually bring house prices down to about 3 times annual household income. In parts of Sydney, they are currently at 17 times. He believes an independent authority should set the proportion of losses an investor could deduct for their investment properties based on trends in the property market. Similar to how the Reserve Bank targets an inflation rate of between 2 and 3%, this authority could be able to reduce deductibility to 50% of expenses when investor activity is driving up house prices. I think you have to put in place policies that are far-sighted, ones that make our biggest asset class as safe as houses, he said. The commonwealth of this nation is tied to home ownership, but we now have home ownership at its lowest level in 60 years. Mr. Wilson is also concerned about housing affordability, warning if people can't afford to buy, then more rising rental costs will lead to a higher need for social housing. There are too many factors driving money into homes to think if we just tinker with supply, prices will decline. The biggest barrier for young Australians to buy their first home is saving enough for a deposit while renting, he said. For this reason, Mr. Wilson wants first home buyers to be able to tap into their superannuation for a deposit. And he also wants a rebasing of the tax system with the same tax rate applied to income also applied to capital growth. Several other coalition MPs support his push, including Senator Gerard Rennick, who wants capital gains tax charged on homes sold for more than $2 million. Australia's runaway house prices are increasing economic instability and contributing to slowing productivity, according to the new research led by UNSW. Commonwealth Bank Chief Economist Stephen Hammerich said at a Commonwealth for Economic Development of Australia web conference on Tuesday that giving buyers more money, including first home buyer bonuses and stamp duty concessions, results in rising prices by driving up demand. Well, at least people are beginning to recognise what I've been saying for a long, long time. It's really going to be important to focus on the supply side. While the population growth rate is down, we have the opportunity to really accelerate the construction of new residential property in Australia, because when the borders do reopen, we're going to have more demand. So there you go, more on the supply side problem rather than actually the credit problem, which is the underlying issue, of course. University of Michigan Professor of Economics and Public Policy Justin Wolfers, also speaking on the panel, agreed driving demand higher would cause prices to rise. That suggests that what we really need is to do everything we can to have a conversation about housing. We talk about supply because it's the supply side that seems to be really very constrained, he said. No, sorry, supply is not the problem, as I've argued several times before. A rise in investors jumping back into the housing market was noted by the Reserve Bank of Australia in board minutes for June, released on Tuesday morning. Acknowledging house prices had continued to rise in all major markets, the central bank board re-emphasised the need to maintain lending standards and to carefully monitor borrowing trends in the environment with strong housing demand, rising prices and low interest rates, it said. Labor's housing spokesman Jason Clare said the federal government should take some pressure out of the market by backing the efforts of New South Wales and the ACT to get rid of stamp duty. A bit of leadership from the federal government is desperately needed here. Getting rid of stamp duty is a good idea, and the federal government could help coordinate this across the country, he said. Doing this will cut the cost of buying a home by tens of thousands of dollars and also get rid of one of the big obstacles that stop people moving and downsizing. We also need to build more affordable housing and more social housing. But I have to say, all of these suggestions are fiddling around the edge. The fundamental issue we have is too much credit availability, and that credit availability will continue to power house prices higher. Unless we actually tame credit lending and change the credit rules like New Zealand has done, nothing will change. And the continued grizzling about lack of supply is being driven primarily by the construction sector, who just want to build more. And of course, if migration does recommence later in the year or into next year, as is more likely, that will put some demand into the system. But the underlying issue we have is that the credit settings are wrong. Interest rates are too low, and that is the issue that nobody wants to talk about. And so the Council of Financial Regulators simply write letters to the banks. Pretty shameful, I have to say. And again, nobody wants to talk about the elephant in the room, to quote again from that University of New South Wales report, which is absolutely excellent, and I do recommend that you read it. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.